Hi, I'm Lena, and welcome to Super Data JP, the channel where we turn Japan's real estate and cost of living numbers into answers you can actually use. Every video here is built on verified government data, not opinions and not guesses. Whether you're planning to invest, relocate, or just curious what life in Japan really costs, you're in the right place. Let's get into today's numbers.
Sell a stock in Japan and you pay a flat 20.315%. Sell crypto for the exact same profit, and you can pay up to 55.945%, nearly triple. Same gain, same country, completely different tax system, and almost nobody realizes it until the bill arrives. Final video in the Money Mechanics series for foreign residents in Japan. IDACO, remittances, and now the asset class with the harshest tax treatment of the three, by a wide margin. Miscellaneous income, Zatsu Shitoku, that's the box crypto profit falls into. Not capital gains, not investment income. A separate category with its own, much less forgiving rules. That classification dates back to National Tax Agency guidance from 2017, written when crypto was a tiny corner of the market. Trading volume has grown enormously since, the tax category never moved. Comprehensive taxation, sogo-kaze, stacked on top of salary and other income. Your crypto profit gets added directly on top of your salary, and the combined total determines your tax bracket. The more you already earn, the harder crypto gains get taxed. 55.945%, the maximum combined rate once national income tax, the reconstruction surtax, and resident tax all stacked together at the top bracket. That top rate isn't one number, it's three stacked on each other: national income tax up to 45%, a reconstruction surtax on top of that, plus a flat 10% resident tax that applies regardless of income level. And it isn't only the top earners who feel it. The national brackets start as low as 5%, but crypto gains get added on top of whatever bracket your salary already puts you in, pushing the combined rate higher than most people expect. Compare that to stocks or FX trading in Japan, a flat 20.315%, no matter how much you already earn. Crypto doesn't get that option, it's stuck in the progressive system stocks escaped years ago. Concretely, someone in the top tax bracket realizes 5 million yen, about $30,864, in crypto gains in 1 year. Taxed as miscellaneous income at the maximum combined rate, 2,797,250 yen owed, more than half the entire gain, gone before it ever reaches an exchange. If that exact same profit had come from stocks instead, taxed at the flat 20.315%, the bill would be 1,015,750 yen, roughly a third of what crypto actually owes. The difference, 1,781,500 yen, about $10,997, in extra tax, purely because of which asset class the gain happened to come from. It gets worse in a down year. Only against other miscellaneous income in the same year, a crypto loss can't reduce the tax on your salary, your business income, or anything outside that one narrow category. Lose money on crypto and profit on stocks in the same year, and the two can't be netted against each other at all. Stock and FX losses carry forward for 3 years, offsetting future gains. Crypto gets zero, a bad year simply vanishes, with nothing to show for it once the calendar resets. And the tax bill triggers more often than most people expect: selling for yen, trading one coin for another, spending crypto on goods or services, and receiving mining, staking, or lending rewards all count. The one that catches people off guard, swapping Bitcoin for Ethereum, is a taxable event on its own, even if you never touch yen. The trade itself realizes a gain or loss that must be calculated and reported, in yen terms, at the moment of the swap. Mining, staking, and lending rewards are taxed the moment you receive them, valued at that day's market price, regardless of what the coin is actually worth by the time you file. Every one of those events needs a cost basis calculated, usually with the moving average method, across every exchange and wallet you've ever used. Active traders can end up reconstructing hundreds of transactions by hand, one by one. NFTs and DeFi protocols make it worse. The tax treatment often isn't explicitly spelled out, so traders and their accountants are left applying general miscellaneous income principles to situations the rules were genuinely never written for. 200,000 yen. For salaried employees, that's the line. Cross it in combined miscellaneous income for the year, and a tax return becomes mandatory. One narrow escape hatch: if annual crypto trading revenue passes 3 million yen and proper bookkeeping is kept, the activity can sometimes be reclassified as business income instead, with its own separate set of rules, and access to deductions and loss carryforward that miscellaneous income never gets. None of this is set in stone forever, though. A real reform is already on the table, and it would close much of this gap with stocks. The government's tax reform outline, released December 2025, proposes moving crypto out of comprehensive taxation entirely and into the same separate taxation regime stocks already use. 20% flat, replacing a rate that climbs as high as 55.945%, regardless of how much you already earn elsewhere. The reform also adds a 3-year loss carryforward, the same protection stock investors already have, finally extended to crypto losses too. It's not a blanket fix, though. The proposal splits crypto activity into 2 zones, and only one of them gets the new treatment. The green zone, eligible for the flat rate, regulated spot trading, derivatives, ETFs. The gray zone, staying under the old rules, staking, lending, NFTs, trades on foreign exchanges, still taxed at up to 55.945%. Timing matters here. This needs amendment to the Financial Instruments and Exchange Act first, and the flat rate isn't projected to take effect until January 1, 2028. Until then, the current rules, the harsh ones, are still what actually applies. A related piece, exempting corporations from tax on unrealized crypto gains, is scheduled to start earlier, but that's a separate change aimed at businesses, not individual traders. Run our earlier example forward to that reform. The same 5 million yen gain would owe 1 million yen instead of 2,797,250 yen, a 1,797,250 yen difference, about $11,094, on paper. This matters most for anyone actively trading rather than simply holding, anyone already in a high salary bracket where crypto gains stack on top, anyone earning staking or mining rewards without realizing each one is its own taxable event, and anyone assuming crypto works like stocks at tax time. It doesn't, not yet. Practical steps: track every trade, not just cash outs, since swaps count too. File once combined miscellaneous income passes 200,000 yen. Don't assume a loss year helps your tax bill elsewhere. Keep records clean enough to defend the moving average cost basis on every transaction. And don't plan around the 20% reform rate until it's actually in force. That closes out this series. Retirement accounts, remittances, and now crypto. 3 very different corners of money mechanics for foreign residents in Japan. Japan doesn't tax crypto lightly today. 55.945%, no loss carryforward, no offset against other income. A fairer, stock-like system is coming for at least part of the market. It just isn't here yet, and until it is, the old rules are the ones that count. Quick recap: current max rate 55.945% versus 20.315% for stocks, no loss carryforward today versus 3 years once reformed, and a proposed flat 20% rate targeted for January 1, 2028, for the green zone only. That's the real state of crypto taxes in Japan today. Harsh in practice, changing on paper. Subscribe for more data-driven breakdowns of money and investing in Japan.
And that's today's breakdown. If you're serious about real estate or moving to Japan, research like this is exactly what separates a smart decision from an expensive mistake. Subscribe so you don't miss the next deep dive, and drop a comment if there's a city or word you want us to cover next. Thanks for watching, and I'll see you in the next one.